Despite the vast number of investing options, strategies, and ways to earn money, as red zone investors, we don't necessarily have to get bogged down in analysis paralysis. We'd like to be like Einstein when he said everything should be made as simple as possible, but not simpler. So if you're interested in simplification or just want another fun idea, hit that subscribe button and join me today, right here in the red zone. Our investing journey can be thought of in three phases. First, we save, we transition, and then we spend. On this channel, I sometimes use longer words or jargon like accumulate, red zone, or decumulation to describe these periods, but it's really not a complex idea. In the saving or accumulation phase, we generally can pick from four strategies: growth, dividend growth, income, or an approach that blends all of them together. It's really the same for the transition and spending phase, but we do need to start thinking a little bit more deliberately about the risks of each one of our retirement paycheck strategies, as we may not just be able to go back to work if we make poor decisions. In a perfect world, we might like a single fund that would carry us from growth to retirement income without having to do much of anything. And a fund that might deliver this for us is in the Adams Diversified Equity Fund, ticker symbol ADX. ADX is an actively managed closed end fund originally established in 1929. It invests in a blend of high quality, large cap companies. Looking at its top 10 holdings, they look similar to the top 10 holdings of an S&P 500 index ETF like SPY. It has a higher expense ratio than that of a passively managed index fund of 0.59%, as ADX is both actively managed and managed to pay a quarterly distribution of 2% of the fund's value to shareholders or 8% annually. You can see that it generates that payout in a few different ways, primarily through selling some of its holdings, realizing primarily long term capital gains. In the accumulation phase, we are primarily interested in growth. So we definitely want to make sure that ADX is growing our investment. If we started investing back in 1996 and wanted to retire this year, we can see that ADX has beaten the S&P 500 in total return since we started investing. And that's not just because it had a great one-off year, as even in other shorter time segments like 10, 5, or 3 years, ADX is consistently beating out the benchmark. It hasn't played out that way every single year, but nothing is perfect. Now, as we transition and navigate the red zone, we still need gains, but protecting what we've earned is critical. We may think that ADX's 2% quarterly distribution or 8% annually can soften the downside of a bear market, but it doesn't really do that always, as we can see in the .com, GFC, and also in 2022. Although its shorter term beta is slightly lower than the S&P 500, when we get a bear market, ADX seems to slightly underperform from a total return standpoint. Now, this is a problem in any asset class or fund, and many investors getting ready to transition to retirement will use a bucketing tactic that I covered in this video, or a simplified barbell tactic where you hold primarily equities with a few years of cash. Let's say we had retired in 1996 instead of starting investing then, and now that we are retired, we are primarily interested in income because we don't have a job or we're working for fun, which probably pays less than our previous job. Even in those down markets, we're still getting a distribution much higher than the dividend payout of the S&P 500, which would allow us to potentially not sell any shares at a loss, especially if we had some cash cushion. If ADX's payout in these down periods was still a little bit more than we needed, we could decide to buy more shares of ADX at a lower price so that when the price rebounds, we have now more shares paying us a higher distribution. With SPY, we would likely not be able to do that, as those small dividend payouts would likely never cover our income needs and we would be spending all of our cash. In fact, as I looked at the history of ADX's dividend payouts from 1996 until 2025, there were only two times where the distribution payout did not cover expenses, with a cash cushion of only about just over $14,000 needed in both 2001 and 2014, compared to that 4% withdrawal rule SPY portfolio, which always involved selling down assets and required keeping a larger cash cushion, sometimes of upwards of $75,000, to avoid selling assets during a down market year. Now, notice that 1996 was probably one of the best years to retire in history if your portfolio had either of these makeups, and you end up with about seven times your initial starting value with ADX versus about four times your starting balance with SPY. So, our retiree could have spent more with either investment, but more than double with ADX. So, the upsides here: first, simplicity of one fund. Although we do need to make this KISS asset allocation a little bit more complex by just adding a short term treasury fund like SGov or a high yield savings account or money market fund. We just need some place to store cash, even if it's just our checking account, as we can't pay for groceries with a few shares of ADX. Second, simplicity of never having to transition your portfolio throughout your entire investing life cycle. You have the same investment every year, reinvesting the distributions, which, if held in a retirement account like a Roth IRA, are reinvested tax free. You can then quit the drip sometime in the pre retirement part of the red zone to start to build a cash buffer beyond your emergency fund, or simply place your new investment dollars into cash or a medium term bucket of bonds. Third, you can start out withdrawing as high as about 8% from your portfolio rather than the historically safe 4%. When you withdraw, you aren't selling down your portfolio. You still have the same number of shares paying you, and then you can decide when you might want to take an opportunity to add to your investment. Next, ADX beats the S&P 500 over long time horizons routinely. It just simply allows you to spend more. And finally, you shift that psychological problem of having to sell assets, which exists due to our innate loss aversion as humans, and you can just collect the fund's income. One of the main reasons that people hire financial advisors is to put someone between themselves and the psychology of investing, including the over hesitancy to sell. Rather than that, you could just invest in ADX and use your position for end of life care or leave it to your heirs. So, what are the downsides? First is the lack of diversification, particularly international equities, small cap stocks. I mean, ADX is a large cap blend US fund. Therefore, there's going to be periods where it significantly underperforms a more balanced approach and also overperforms. It also lacks diversification in fixed income assets or commodities. There's no bonds, business development companies, master limited partnerships, precious metals, very few REITs, or any alternative assets. Finally, a market decline would reduce your income payout by about the same amount proportionally as the fund's price decline. Again, this can make your payout unstable over the long term. So, what are some alternatives? We could simply invest in a one fund target date fund. Now, this only fits if your strategy to generate retirement income is decumulation or selling your assets. They generally have higher fees than most index fund approaches. And with a target date fund, when you do sell, you don't get to pick what you sell. You just sell, and the fund sells proportionally to whatever the balance of assets the fund is trying to maintain. So you might be selling some things high, but selling other things low. Second, you could change your strategy or your investments along the way. You could take a blended approach. You could initially start to invest for growth, then transition to growth and income, and then finally sell some of that and transition to income assets. Now, this may be better than just buying ADX and holding from the beginning in terms of diversification, but you would have to adjust and would pay taxes on the gains from your brokerage account, and it's not exactly keeping it simple. In summary, the best feature of ADX is that it keeps up with the S&P 500 during accumulation, and only doesn't when you choose to start taking up to an 8% distribution rather than a starting withdrawal rate of 4%. It could be a single fund solution if you use a barbell with cash or decided to use a bucket strategy, including some bonds as well. It does, however, have downsides, including your payout likely declining by a similar percentage of the S&P 500 in like a medium or longer term bear market scenario, and it lacks diversification. It's better than SPY and cash in a recent retiree scenario, but like I said, it's not a fully diversified portfolio and therefore increases downside and ultimately retirement income risks in different 30-year historical periods. So, is simplicity for your portfolio important to you? And if so, how do you simplify? Feel free to let the community know what's in your simple portfolio by leaving a comment below. Until then, I'll see you next time right here in the red zone.